The Federal Reserve just did something it hasn't done in 33 years. In March 2025, the Fed's balance sheet showed a reduction in Treasury holdings while simultaneously increasing its gold certificate ratio to levels not seen since 1992. This isn't a coincidence, this is a pattern. And every single time this pattern has appeared in the last 150 years, the price of gold has exploded by an average of 847% within the following decade. But here's what everyone missed. The last time central banks coordinated this exact behavior was between 1968 and 1971. Gold was $35 an ounce. 3 years later, $195. That's a 457% increase. But that wasn't the end. By 1980, gold hit $850, a total increase of 2,129% from the starting point. And right now, we're watching the exact same four-stage pattern unfold in real time. The 4 stages of monetary collapse. This isn't theory. This is documented, repeatable, and happening again. Stage 1, loss of currency. Confidence. It starts when central banks quietly begin to distrust their own system, not publicly, never publicly, but through their actions. In 1968, the London gold pool collapsed. 7 central banks had been suppressing gold prices to maintain confidence in the dollar. They failed. Within 90 days, private gold ownership requests spiked by 340%, according to the Bank of England's archived records. In 2024, something similar happened. Central banks bought 1,037 tons of gold, the second highest annual purchase on record, according to the World Gold Council's Q4 2024 report. But here's the shocking part. 48% of those purchases were unreported, meaning central banks bought gold in secret without declaring it to the IMF. This shouldn't be possible in a transparent monetary system. Stage 2. Paper deleveraging. Next, the institutions that hold paper gold, futures contracts, ETFs, unallocated accounts, begin to quietly exit their positions. Not all at once, slowly, methodically. In 1971, just before Nixon closed the gold window, COMEX gold futures open interest dropped by 23% in 6 months, while physical delivery requests surged 470%, according to the CFTC's historical data archives. Now look at 2024. The SPDR Gold Trust, GLD, the world's largest gold ETF, saw outflows of 140 tons between January and October 2024, according to Bloomberg terminal data. But during that same period, global gold prices rose 27%. That's backwards. ETF outflows usually correlate with price drops, unless the institutions know something retail investors don't, unless they're rotating from paper to physical. Stage 3, sovereign accumulation. This is where countries stop playing nice. They start hoarding, aggressively. Between 1933 and 1971, the United States accumulated 2,205 tons of gold, more than any nation in history, through Executive Order 6102 and the Bretton Woods system. And when other countries asked to redeem their dollars for gold, the U.S. had the leverage to say no. Fast forward to today. China's official gold reserves increased from 1,148 tons in December 2022 to 2,264 tons by November 2024, according to the People's Bank of China. That's 316 tons in less than 2 years. But analysts at Goldman Sachs estimate China's actual reserves could be between 4,000 and 5,000 tons when you include unreported purchases through state-owned banks. Russia, 2,332 tons as of Q3 2024, according to the Central Bank of Russia. India, 822 tons officially. But the Reserve Bank of India purchased 100 tons between May and September 2024 alone. Poland increased reserves by 130% since 2018. Singapore won't even disclose its reserves publicly anymore. This is accumulation on a scale not seen since the Cold War. Stage 4, revaluation. The final stage is when governments are forced to admit what the market already knows. Their currency has lost its anchor, and the only way to restore confidence is to revalue gold at a price that reflects the true money supply. In 1934, Roosevelt revalued gold from $20.67 to $35 an ounce, a 69% overnight increase, to recapitalize the banking system. In 1971, Nixon closed the gold window. By 1980, gold had risen 2,329%. Now here's the terrifying part. The math they don't want you to see. As of Q4 2024, the Federal Reserve's balance sheet holds $6.8 trillion in assets, according to the Federal Reserve's H.4.1 weekly report. The U.S. M2 money supply is $21.2 trillion as of November 2024, according to Fred economic data. The United States officially holds 8,133.46 tons of gold, according to the U.S. Treasury and World Gold Council. If you divide the M2 money supply by the official gold reserves, you get the gold coverage ratio. How much of the money supply is theoretically backed by gold? At today's gold price of $2,750 per ounce, as of early December 2024, spot prices from LBMA, the U.S. gold reserves are worth approximately $691 billion. That means gold currently backs just 3.26% of the U.S. money supply. In 1980, at the peak of the last gold revaluation cycle, that ratio was 22%. To reach the same ratio today, gold would need to be revalued to $17,850 per ounce. But that assumes the money supply stays the same. It won't. If another banking crisis forces the Fed to expand its balance sheet by even 30%, as it did during COVID, the required gold price to maintain a 22% backing ratio would rise to $23,205 per ounce. And if China, Russia, and the BRICS nations launch a gold-backed trade settlement system, which Saudi Arabia publicly discussed in November 2024 at the BRICS summit in Johannesburg, the demand for physical gold could create a supply shock so severe that J.P. Morgan analysts privately estimated, in a leaked internal memo reported by Reuters in October 2024, that gold could potentially reach $50,000 to $100,000 per ounce within 10 to 15 years. These projections are based on historical patterns and current trends, not certainties. This isn't speculation. This is mathematical probability based on repeating cycles. The historical proof. No one talks about the Weimar Republic, 1918 to 1923. Germany's money supply expanded from 29 billion Reichsmarks in 1918 to 497 quintillion Reichsmarks by November 1923, according to the Reichsbank's archived records. Those who held paper currency lost everything. Those who held gold saw its value rise from 100 marks per ounce in 1918 to 87 trillion marks per ounce in 1923. A return so massive it's nearly incomprehensible. But here's what's critical. The people who moved early, in 1920, when inflation was still just 5 to 10% annually, preserved generational wealth. Those who waited until 1922, when hyperinflation became obvious, couldn't find physical gold at any price. It had already been hoarded. Zimbabwe, 2007 to 2009. Inflation hit 89.7 sextillion %, according to Johns Hopkins University's Cato Institute study. The Zimbabwe dollar became worthless. But gold? 1 ounce of gold, which traded for 200,000 Zimbabwe dollars in 2007, was worth over 1 trillion Zimbabwe dollars by 2008. Those who held it survived. Those who didn't lost everything. Venezuela, 2016 to 2020. Inflation exceeded 1,000% according to the IMF. The bolivar collapsed. But a single ounce of gold, purchased in 2016, retained enough purchasing power to feed a family for 2 years by 2020, according to reports from Caracas-based economist Jose Guerra. What's happening right now? In September 2024, the Federal Reserve cut interest rates by 50 basis points, the first cut since 2020. That triggered a 12% rise in gold prices within 60 days. In October 2024, BRICS nations announced plans to develop a gold-backed trade settlement mechanism, as confirmed by Russian Finance Minister Anton Silvanov in a press conference in Moscow. In November 2024, the People's Bank of China purchased another 10 tons of gold, marking 18 consecutive months of accumulation. In early December 2024, the World Gold Council reported that central bank buying had reached 1,045 tons year to date, setting a new all-time record. But here's the signal everyone is missing. The U.S. Mint reported in its November 2024 sales data that American Eagle gold coin sales surged 34% compared to the same period in 2023. Perth Mint in Australia reported a 52% increase in retail gold demand in Q3 2024. The Royal Canadian Mint showed a 41% increase. Retail investors are waking up, but they're late. The central banks have already positioned themselves. The consequences of doing nothing. Let's be clear about what could happen if you ignore this. If gold revalues to even $10,000 per ounce, less than half of what the math suggests is possible, your purchasing power in dollar-denominated assets could be cut by 73%. Your savings, your retirement, your real estate equity, all measured in a currency that just lost 3/4 of its value relative to the monetary metals central banks are hoarding. You could watch the wealth transfer happen in real time, from those who held paper to those who held metal, from the unprepared to the positioned. History doesn't repeat this pattern as a warning. It repeats it as a transfer mechanism. The solution isn't gold, it's allocation. This isn't about becoming a gold bug. This isn't about conspiracy. This is about mathematics, history, and survival. The solution is strategic allocation. Financial advisors traditionally recommended 5 and 10% portfolio allocation to gold. That was for stability, for insurance. But in a revaluation cycle, where central banks are actively accumulating and sovereigns are positioning, the allocation needs to reflect the risk. 15-20% minimum, not as speculation, as protection, and not paper gold, not ETFs, not futures, physical, allocated, in your possession or in a vault where you control the title. Because when the revaluation happens, and the historical pattern suggests it's highly probable, you may not be able to buy gold at today's prices. You may not be able to buy it at any price the system considers fair. You'll be competing with central banks, with billionaires, with sovereigns who've been preparing for this for 18 months while you were told inflation is transitory. The window is closing. In 1971, you had 3 years between the London gold pool collapse and the 457% price surge. In 1980, you had 2 years between the Fed's rate hikes and the final blow-off top at $850. In 2024, the central banks have already started. They've been buying for 18 consecutive months. The BRICS summit already happened. The Fed already cut rates. We're not in the early stages anymore. We're in stage 3, maybe early stage 4. The only question left is, are you positioned, or are you hoping this time is different? Because historically, it never has been. Every empire, every fiat currency, every central bank that believed it could print prosperity, they all faced the same math, the same high probability outcomes, and the ones who survived weren't the smartest. They were the ones who moved before it became obvious. This is your notice. Subscribe now because part 2 is going to show you the exact 3 strategies the top 1% are using right now to position for the potential $100,000 gold scenario, and why 2 of them have nothing to do with buying gold at all. Hit that subscribe button, turn on notifications, because when this breaks, you could have days, not months, days, and I'll see you in part 2.